Kenya was facing a very nervous election. Nigeria was still recovering from a very difficult economic depression and currency erosion that was triggered by the plunging of the global oil price. South Africa was grappling with the state capture by the Guptas. Zimbabwe, the sudden exit of Mugabe, completely unforeseen. Yet global monies were flowing into Africa, and it was generally a very good year in terms of investments, and all markets were on the rise. Kenyan investors in Kenya made a whopping $520 billion between billion shillings between January and December to 2017. This year, between January and September, we have had the issue of Trump triggering trade wars with China. The U.S. economy has been strengthening. The U.S. interest rates have also been strengthening. And global monies have been shifting from what is perceived to be high-risk markets like Africa and other emerging markets. And it's been a very difficult year, especially between April and September, where investors have lost more than 290 billion shillings in just under nine months. And this is the nature of markets. Markets do go up and down depending on what is happening in the operating environment. And investors who are seasoned must be comfortable to be able to live with market volatilities. So in today's video, I'll be explaining to you why do markets go up and down. And my name is Pius Mugo, the Managing Director of Nabo Capital, and you're watching Invest in Africa. So why do markets go up and down? First and foremost, it's all about supply and demand. When there are more investors in the market who are on the demand side, markets will tend to go up, or share prices will tend to go up. When there are more sellers in the markets, markets will tend to go down. And that's really what a market is, a place where people or investors with different opinions would come and meet. And what do I mean this? But what do I mean by this? If all investors had the same opinion, it means that they would actually all of them be buying or selling at the same time, and there will be no one to buy from the other or no one to sell from the other. And that is one reason why markets do go up and down. The supply and demand imbalances. The second reason why markets do go up and down is because investment is all about the future, and the investor who has the best sneak preview of the future tends to win. So investors like ourselves, we spend most of our time doing research, understanding trends, what is likely to happen tomorrow. And because of the difficult nature of predicting the future, then there are all these uncertainties and all these different opinions in the market, and this tends to cause markets to go up and down. So this is really the reason why markets do go up and down, and sometimes prices can fluctuate in a very drastic and frightening manner, but that's the nature of markets. There will be no investment without market volatilities. And in the next video, I'll be explaining to you how opportunities come wrapped in these market volatilities of fluctuations. Thank you for watching. I hope this video has inspired you and encouraged you that seasoned investors must be comfortable to live with market volatilities. If you want to engage us, as always, please write to us on our various social media platforms, or you can come to our offices at International House, 5th floor, or you can call us on the number that is on the screen, or you can even email us on the email address that is on the screen. My name is Pius Mugo, the Managing Director of Nabo Capital, and you're watching Invest in Africa.